Here before we start, Bronwen.
I know, I just thought.
We're already live.
Yeah, mine's gone there. Perfect.
I'm going to say good evening, good evening. Yes, indeed. It is Monday, the 5th of July. ¿Cómo estás? Actually, that's in Spain, I might say that. How are you? But welcome, everyone, for the Property Expert Panel, where we answer your property investment questions. There's a bunch of us on the panel members this evening, so I'm going to pass over and let them introduce themselves, and then I'll come back to me. So, Bronwen, why don't you make a good start?
Yes, fantastic. Hi, everybody. My name's Bronwen Vearncombe. I'm a property investor down in Hampshire. So I invest in Southampton, Portsmouth. I have houses of multiple occupation, holiday lets, guest houses. I've done some conversions and some new build developments. So quite a portfolio, really. I also coach and mentor people, and I'll touch on that a little bit later. So that's me, and let's go over to Teresa. Ladies first.
Yes, good idea, Bronwen. The best first. Yes, hi everyone. I'm Teresa Kaczmarek. I'm here representing the National Residential Landlord Association. So as it says in the title, it's, you know, if you've got any questions about landlord in private rental sector, then please do ask me. I'm a landlord as well, HMO landlord. So yeah, if you've got any questions surrounding that, please do ask. If you want to know a bit more about me, there's a bio on me on the NRLA website. So I shall move on for the sake of speed. On to Simon Hodgson.
Right, yeah, good evening, everybody. Simon Hodgson from Funded. So that's mortgages, funding and finance, effectively. So I've been involved in property for 20 years. Started out learning from a guy called Russ Whitney, who is a guy from America. Soon learned that most brokers didn't really understand investors and kind of cut my teeth there. I've done flat conversions, title splits, grade 1 listed townhouse buildings, renovations, learn how to lose it all through the credit crunch, build it back up, and effectively put into place funding for strategies or all sorts of strategies. Anything that you could think of, I can help with. Right, I'm going to hand across to Paul. I think Paul.Hilliard.
Good evening, everybody, and welcome to tonight's Q&A expert panel. My name's Paul.Hilliard. I've been a portfolio landlord, and I started way back in 1992, so almost 30 years now. I've got HMO, service accommodation, family lets, but I'm also the operations director for LNPG, which, as everyone knows, is the Landlords National Purchasing Group. Everyone knows that landlords' business costs are going through the roof and not in proportion to our rentals. So some landlords have been fortunate enough to discover LNPG. So come and find out more. We do B&V, kitchens, bathrooms, boilers, double glazing windows, flooring, doors, tiles, bricks, in fact, everything you need for a refurb. So find us out, www.lnpg.co.uk. And I'll pass over to Wayne.
Hello, everybody. Welcome to the Property Expert Panel. My name's Wayne Norcliffe. I've been working in building and construction since I was 15, so about 5 years now. And chartered surveyor, fellow of the RICS, associated building engineers, and managing director of Castle Surveyors Limited, providing residential and commercial property consultancy and surveying services across the South Coast. I'm going to hand you over to Simon, I believe.
Yes, indeed, it's back to me. Thank you ever so much. I am Simon Misiewicz from Optimised Accountants. I'm your property expert panel member who focuses on property tax. So that's without kind of going into too much detail. You know who I am if you're watching the YouTube channel. All I would ask you to do is make sure that you press the like on this video if you believe that this is adding value to your day and cheering you up out of the rain that you might be facing in the UK. Bronwen and I are having nice lots of sunshine. Thank you very much. Moving on from that, though, make sure you do subscribe to this channel and make sure that you get to see all the latest videos. Every single week from now on, I will take a snippet out of this video and republish that onto YouTube channel. So you'll get to see a summary of our videos going forwards. And in fact, I've been running that for the last 2 weeks. If you do have a question, it is a live session. I can't emphasize that anymore. So make sure you will notice that I keep moving to the left and looking down in my new studio, which is only there because I want to see your questions that you have posted, and then I can give those to the panel members for them to to be answered. Without further ado, I want to kick off tonight. You'll notice I'm looking at my down because I'm looking at my phone with a bunch of questions that have been already asked. So let's go to it, panel members. The first question was from one of the co-chiefs of Bronwen's, funny enough. And this is really interesting because I know that you can have infrared remote controls to turn off the football if you're not into football, or you can turn the volume up for whenever we score. We scored 4 against Ukraine, sorry Ukrainians. But there is something called infrared heating. Do you know anything about it, or someone that's using it? I personally have never heard of infrared heating at all in my times. So I don't even know who to pose this to. Okay, so if any panel members can put their virtual hand up, then feel free to kind of do that. Wayne, go for it. I'm glad that someone saved my bacon.
Can you hear me okay? Yeah.
Indeed.
Okay, so I've been doing, just to add really to what you've said, Simon, obviously infrared heating, I'm imagining it's some sort of heating via infrared. There you go. Does that help? The reason I say that is because I've been, as I said earlier, working in building, construction and surveying since I was 15. I have yet to see an infrared heating system installed in any property I've ever been in, and that's commercial or residential. I've been in lots of them, never come across it. But my initial thoughts are, firstly, if it's anything like the outdoor patio type heaters, it'll be expensive to run. I'd be surprised if it's not. Any electrical heating generally, unless it's a storage type, is probably going to be more expensive. And again, if it's infrared, it's probably localized where the heaters are, and therefore more difficult to heat a whole building. But again, I'm only guessing. The reason I've put my hand up is to say I've never come across it either, really. So it's quite an unusual type of heating.
One of our suppliers actually does supply infrared panels. So I would suggest, if you want to learn more, go on Electric Radiators Direct, who are an LNPG approved supplier. Obviously go and learn from them. They talk about, should you buy electric radiators or infrared panels? What's the best electric heating system? So if you are very interested in that, then go on their website, have a look at it. And obviously, if you're an LNPG member, then you'll get seriously good discounts on infrared panels. So hope that helps.
Very good, very good. I think you've heard it all here first. I've never heard of infrared these kind of heating systems. Be interested to see what they look like. So if there's anyone got a picture of it, make sure that you post it. As I've just stated that at the earlier point, this is a live session, whether you are on YouTube, whether you are on LinkedIn, Facebook, or indeed Twitter. We are live on all of those social media channels. So make sure that you post your questions there as well. And we should be able to get your questions all wrapped up within my one platform. One of the questions I had, and this is to Simon Hodgson, funny enough, it's regards to buying holiday lets below market value. So bearing in mind that's the strategy holiday lets, not just a standard buy-to-let. It was regards to buying below market value, but then saying that they believe, Ms. Clegg, this is, was the minimum value for mortgages is 125,000. What's the story around typically buy-to-lets? What's the minimum kind of pricing for a property whereby I can get to mortgage? Because I know there's something there as well. And then focus on holiday lets as well.
Right, okay. So first of all, if we take a buy-to-let in your own name, so that's not an unlimited company, typically lenders tend to start at £40,000 as a minimum value. So there's a few at £40,000. There are a few very obscure lenders that will go below that, but the rates creep up quite dramatically. If you then go to limited company, most limited company lenders tend to start at 60,000, although there are a few at 50,000. Conversely, if you're doing a holiday let, tends to be 100k is the minimum property value, although again there are a few building societies out there who will go below that, down to about 75. Really depends on the asset, where it is in the country as well, because there are a few lenders that will make exceptions for below that. But yeah, if not, there are also some challenger banks who offer what's known as a mid-term product. So you could take a 5-year product that isn't underwritten as a mortgage product that could be utilised in that fashion, and rates start though for those at 4.99. Slight penalty, but it's not bad. You're muted there, Simon. I think
Yeah. Do you know what I've done accidentally? And this is totally a professional, and Teresa will be straight on me, not in that way, but she'll be straight on me later on to say how unprofessional I've been, because I've literally missed out on all the slides that you guys have beautifully prepared for me. So that is really bad of me. So I can only apologise for my faux pas. So what I'm going to do...
You're sacked as host now, Simon.
Oh,
Sorry.
absolutely.
No, I'm joking.
I'm going to be relegated to the ITV. For anyone who's on ITV, I do apologise.
Well, it gives people a chance to put their questions in the chat box in the YouTube. Yeah. So if people can think about the questions that they might have, obviously we've got a lot of questions in advance as well. So those that sent them to me in advance will get them answered. So, even if it ends up being in the quick fire bit at the end. So
well, exactly.
Yeah.
So let's go through the slides anyway. So Wayne, it's your turn first. If you want to go through your slide, and then we'll move on.
Can you hear me? I'll keep it brief. So just some headlines really from Rightmove, just to show how the market's moving still. We still seem to be in a phase of upward momentum in most areas, though I think it's fair to say we're starting to level off now. Stamp duty has, we've lost one element of the reduction, but it's starting to level off in some areas. There's been growth, as we've said last week, I think, in the Southwest and Wales. No surprises there, really. Demand is still being pushed by people who are escaping the cities, trying to get to rural locations where they can still work from home a few days a week and then enjoy the benefit of being by the sea. And as we can see there, the number of sales agreed over 500,000 is up 49%, which is huge. And again, is that being driven partly by people who are able to sell a property, say in London, take that £2 million for the studio flat that they sold in London and come down where I live and buy a 6-bedroom detached house? It could well be. But generally speaking, as it stands at the moment, the market is still on an upward trajectory, albeit, fair to say, levelling off, and that's been done.
Wow, that is a very, very good, efficient slide. So thank you ever so much for that one. We're going to move over to Teresa.
Good evening. Yes, I certainly wouldn't slate your job as a horse there, Simon. And if I do, it's only because I'm trying to protect you. We don't want to lose you. We don't want you going to the BBC. So you're doing a cracking job. So I'm going to try and be as quick as Wayne. I just thought I'd just throw in a bullet point about the number of statutory provisions, all like the regulations that landlords are subjected to in the sector, which is basically it's risen by 40% in the last decade. And I put like a question mark just to give you a momentary tease there as to how many regulations there are, but I'll put you out of your misery. It's 168 pieces of legislation, and in there includes things from like the 1730s, the Landlord and Tenant Act, in 1737, the Distress for Rent Act. It is quite a mess, and this could account for why councils aren't, issuing civil penalties for landlords who are not following legislation, probably because they can't pinpoint, which one out of the 168 they can pin on the landlord. So the NRLA are pressing for this to be, completely tidied up, if you will, and just to have in there the legislation that does purely apply to landlords and not make it so, wieldy. And that's another reason to join the NRLA, because we do help you navigate through this soup of regulation, making sure that you are abiding by the law and, you know, ticking all the boxes that you need to tick, which is important because if you're trying to get somebody out or in a property, you know, you need to make it as legal as possible. I just wanted to talk briefly about a fundamentals course that the NRLA offer. I like to, you know, to highlight this because, you know, for landlords who are, well, people who are new into property investing, who do want to get some foundation level education on the basics, then that is a great course, you know, at a really good price, and especially if you're an NRLA member, then you do get a discount, but it's a good price all the same. You don't have to be a member to take that course either. I've just popped in my discount code, R123, if you want some money off a membership, if you are going to join. And I just wanted to talk about just a couple of the webinars that we've got coming up in the next month. Right to rent, that is a good one if you've got tenants coming in from outside of the UK, because, you know, they are changing the rules on that slightly, so it'd be good to get up to speed on how you need to be dealing with tenants' paperwork who are coming in from abroad. And that's the 21st of July. And then we have a new supplier on board called Loft. Basically, they supply furniture, so they can supply furniture to your property to, if you are doing fully furnished, part furnished, they'll come and dress your property for marketing purposes. So you might want to check that out on the 28th of July. And that is my update. Thank you, Simon.
Thank you, Teresa. Just a quick question on this, and I'm just going to ask the panel members, just out of interest. How many of you are NRLA members? Because I know I am. So is anyone else who are NRLA members? Yeah. So for anyone that's listening out to that saying, well, is NRLA really worth it? Look, we are experienced over probably 30, 40 years of experience with Paul.Hilliard, 250 years of experience. So, you know, it's worth looking into the NRLA. And Teresa, just one thing question I had was regards to the furniture. You mentioned about dressing up, but because we've got a question later on talking about renting or leasing furniture. Will this company do that as well?
These are basically purchasing the furniture.
Okay, fair enough.
Not leasing it.
Okay. Fair enough. So let's go over to Simon Hodgson. Now, anyone who's listening to us live behind the scenes, we have got a new device. It's an electrode for Simon, so it goes over a period of time. We just buzz that. So if you see him shaking, it's not his camera. That is him going to be shaking. So Simon, you've been warned. So why don't you make a good start on your first slide?
Okay, right. We're going to talk very briefly about short lease flats and getting over 100% of the purchase prices funded by a lender. Right. First slide done, Simon. I'm on track.
I'm not having that. Surely that's not right.
Okay. So what we're going to do, we're going to use a bridging lender. This is a bridging lender called Apex. They do stuff that's a bit out of the ordinary. We all know that bridging is expensive, but if you use it in the right place, the right thing, it will work great. And they like short lease flats, particularly less than 50 years, but they'll do stuff just over it. And yeah, next slide if we can. So basically, I'm going to highlight a little deal that I've done here. So this was done after this person got themselves educated. Again, you could reach out to someone like Bronwen on the call to get yourself educated on short lease flats. In terms of conveyancing, he's not here tonight, unfortunately. However, should you wish to, you could reach out to Bronwen and Bishop, and I'm sure they could help you. So effectively, what you've got to do is get the current seller to trigger clause 42, which is the right to extend the lease from the current freeholder. Agree with the freeholder what you're going to pay to extend that lease, because the freeholder will want to charge you. And in this case, it was £40,000 on top of the purchase price of 132. And 132,000 plus the 40k lease extension meant that the flat was now worth £210,000. So we can move on to the next slide, Simon. That meant that the bridging lender was prepared to lend off the £210,000 end value with the lease extended on completion, which meant they gave a loan of £138,297 towards the purchase price of a flat at £132,000. So the client's actually just paying for the lease extensions and buying costs, which they borrowed from an investor. Funnily enough, Bronwen can teach you how to do that. You need to do it correctly, so there are ways you need to structure the borrowing, etc., etc. And we're going to touch upon one of those questions later on tonight. It also needed a refurb, and after the refurb, so it completed 10k refurb, very simple, bathroom, kitchen, floor covering, wall coverings. It now has an end value of £250,000, and the exit lender will be offering a loan of £187,500. That's 75% of the 250 as an exit loan. Could have the next slide, Simon. Meaning, cash required to buy, 33,703 plus the 10k refurb, all money back out apart from the buying costs, your stamp duty and solicitors, with an infinite return on investment after the remortgage. Hands up, everybody who wants one of those. So we need to see everyone's hands. Yay! There we go. Not too long. Thank you, Simon. Handing you back.
Wow, that is astonishing. Simon, you get a gold medal for that. That is Usain Bolt speed. So thank you ever so much for that. By the way, if anyone's noticed, when I've been flicking around screens, I've been lifting up devices so I can read your questions properly, and you might have seen my wrist. That's not because I'm being sectioned in a mental asylum or anything like that, by the way. That's just because I'm actually in a all-inclusive holiday. So I do want to really make that point clear to you guys, just in case you're wondering what is going on with that. So I'm not sectioned, albeit my wife would love me to be sectioned just for a weekend. Okay, so that's Simon's details. Someone that was asking on the chat box, which I think Simon Roberts was asking for your details. So I've put that on www.funded.co.uk. And of course, you can send Simon an email as well. We'll talk about this later on, actually, so we'll go leave that for now. So let's, what I'll do is stop the share and we'll go back to our questions. Now, because I want to prove that indeed this is live, what I want to do is go to a question. Simon, this is actually for you, my good man. So Adam Wright on YouTube live asked a question: down payment on a bridge loan, I think loan mortgage is 35% or roundabout. I only have 20%. Could I buy it on a residential at 10% and then sell it? Would the fees be excessive? Are there any alternatives? And I think it's probably just cutting through that. If we talk about bridge loan finance and then raising finance from credit cards, as we talked about before, getting money from friends and stuff like that, if people are falling short of the deposits, what can people legitimately do?
Okay, legitimately, a little bit like the bridging lender that I've just made an example of there. If we can prove that the value of the property that you are buying is higher than the purchase price that you're actually buying at, we can use that discount to actually form part of the deposit. So you don't necessarily need 35%. So with bridging lenders, we can go up to 80%. Generally, 75 is the highest with most. You can do it on a serviced basis so that it is a genuine 75% loan. On that particular suggestion, if I'm not mistaken, they're suggesting using a residential mortgage to buy an investment property.
That is correct, yeah.
That's not a good thing to do. The T's and C's of any mortgage will dictate what you can and can't use the money for and what you should and shouldn't do. And absolutely, a residential mortgage is for you to move into and to live in, not to buy as an investment and to add value to sell on for profit. Specifically because you should take out a bridging loan to do that kind of thing. And it's priced accordingly due to the risk potentially that the lender and the funding lines see within that profile. Without wanting to put too fine a point on it, that's called mortgage fraud, and we do not, as part of the panel members, endorse anything like that whatsoever.
No. Thank you ever so much for that. Bradley is asked a question through Bronwen's Property Foundation list. Said, if I've missed the SDLT deadline on a purchase, how does the tapering off benefit work, please? I'm likely to miss out on up to 5k benefit Bradley, you are right. That's the SDLT benefit has gone in terms of the marginal 500,000, but we still got the £250,000 holiday period. Let's not forget, and that doesn't go out into, or doesn't close out until October. So in reality, we have still got that benefit. So don't worry too much. But what I would say to anyone listening out on this is, if you are trying to get a purchase, as Tim would testify, that conveyancing solicitors are really up against it at the minute. So if you want to get this SDLT benefit, please don't wait until the last minute to get things done. It won't help you. You'll end up being frustrated, and you'll end up paying the extra SDLT. Tom's asked a question. Please explain the pros and cons of leasing, and this is where I'll talk about now, Teresa. So Tom has asked, please explain the pros and cons of leasing furniture and electrical goods for HMOs and SAs, service accommodation. And just my personal experience on this, we've got plenty of clients, some that are cash strapped, some of them that are doing well with their money, and they'll buy the furniture outright. I've recommended that people speak to companies like Fusion Furniture before, Forbes Rentals. I'll put some links in actually, just so you can have a look at this for yourself. I can't really vouch. I've used Forbes Rentals for myself, funny enough. It was something that I'm sure we've all had grandmas that have rented out their TVs at some time in the past. I know my grandma did. So we've used them, but I'll be interested to see what other people think. So Bronwen, why don't you make a start? And if any other panel member wants to chip in, maybe Paul.Hilliard on this one, because you're so close to connect. So Bronwen, why don't you first start?
Yeah, thank you. So when you're starting out in property, you know, if you're looking to build a portfolio fairly quickly, as indeed my husband and I did, you run out of cash very quickly, and cash flow is really important. So what we were doing as we were building up our portfolio of HMOs, houses of multiple occupations, so multi-lets, because they're all furnished, and you know, you're also providing obviously fridge, freezers, washing machines, televisions, you know, the works. It's very expensive, and although we use companies like, we do use Let Us Furnish, Fusion, you know, people that can come in and, you know, basically furnish it for you. If there's a leasing option, it's obviously better for your cash flow. Now, for electricals, I've used a company called Forbes, F-O-R-B-E-S, Forbes. And what I found was really useful for them is that for the electrical appliances, not only could I rent them or lease them second-hand, really good refurbished ones, which made it cheaper, but also if something went wrong with them, they had a service level agreement where they would come out next day and fix it. Now that's worth a huge amount as an investor, because, you know, any issues, especially in an HMO, you need someone to come out quickly. So I found that using Forbes and leasing saved me a lot of money, but also later on when I had the cash flow, I could buy them off them. So they would just do the calculation and say, if you pay me X, you know, they're yours. So it was for cash flow, really. Those are big pros for me. I'm sure others have got views.
And Bronwen, just to let you know, I've put in the links to those websites that you mentioned. So that's already on the chat box, guys. So have a look at those. Paul, what's your thoughts?
Yeah, I wholly recommend, if you're interested in doing this, speaking to James Quinn at Fusion Furniture. He's obviously the LNPG link person associated with us. But yeah, speak to James. I think there's a couple of cons. I mean, Bronwen's mentioned all the positives there: save cash flow, very good for tax relief. But the cons, I think, are, and someone might be able to correct this, does it not have to be done in a limited company?
No, you don't have to.
No.
All right. Okay. And the only other thing was that you don't actually own it until the balloon payment's made at the end. But other than that, yeah, brilliant for cash flow purposes. And as you say, there's on the electrical goods and the furniture, brilliant. Recommend Fusion. And speak to Currys because they'll do a long-term plan to finance it. So over to you guys.
Perfect. Thank you ever so much for that. So next question then. So Dinesh has asked the question. I've been approached by a build to rent. Sorry, Teresa, you put your hand up, so I do apologise. Teresa, do you want to chip in there?
God, I was feeling left out there. I thought I don't want to interrupt because it'll might look unprofessional. But yeah, I was just saying that I do rent out my electricals, and it was the best thing I ever did, because being in a HMO, you've got, you know, lots of people using appliances, and then soon enough, you know, a couple of years seems to, like, you know, go by quite quick, and before you know it, things start going wrong with the appliances. So I just love that I can just ring somebody up, and most of the time they don't even bother to repair it, they just wheel a new one in. So I highly rate it, and I use a company called Hughes.
How do you spell
Hughes, Hughes. I know it's my accent. It's Hughes Trade. So I use them, and I'm not bothered that I'll never own it, because it just always gets offset against my, you know, my rental.
I'm going to put that straight into another link. So thank you so much for that, Teresa. And Teresa, no one could ever fault you for your lack of professionalism. I think we all think you're brilliant. I can vouch for that indeed, especially with the smooth face that you have. Unbelievable. I'm sure that Paul.Hilliard can learn a lot from you on this one, I've got to be honest with you. So Dinesh has asked a question. I've been approached by a build-to-rent company to invest in their next project. The numbers sound very good, but I'm skeptical since I have no knowledge of it, and the numbers are too good. And we all know what the phrase is regards to, if it looks too good, ... Answers on a postcard, please. May I ask if any of the panel members have had any views or experiences with build-to-rent projects in the UK? I'm going to go to Bronwen and Wayne, and if anyone else wants to put their hands up, maybe Simon actually at the end. So have a start, Bronwen, and then move over to Wayne, then finally Simon.
Yeah. Hi, Dinesh. So the big thing about build to rent, it's another phrase that's been used a lot in the last couple of years, especially in big cities. So London, Birmingham, there's been some very big announcements. Even this month, there's been some big announcements around the biggest build to rent scheme ever, I think is in Birmingham. And, you know, they work really well because of the permitted development for office to residential, but also there's a lot of this new build. So this is new building to rent. Now, I think it's highly profitable. I think it's a good investment, but what you've got to do is your due diligence. And if the numbers that you sent us through with your question are right, you know, it looks extremely beneficial. However, you know, you do need to check these people out, and also you know, there are different schemes, and you might need to be a sophisticated investor to participate in those schemes. So I've got a few links to articles, so I'll pop those across to Simon in a minute, to things that I've read about it. I haven't actually done it myself. I've certainly thought about it, and the numbers were very attractive, I must admit, but you've got to have the demand. It's got to be demand in the area for it to work well. So yeah, over to Wayne or someone else.
Hello. Yeah, am I on? Build to rent. Well, like any, I think it's fair to say, as Simon says, if it looks too good to be true, ... Now, therefore, if it looks too good to be true, do that extra bit of due diligence is what I would be saying to you, because ultimately there have been stories of people forward funding such investments only to find when it comes to them thinking that they've got the return, i.e. somebody's in the block, that the developer's gone out of business or the scheme has failed in some other way. So do your due diligence is all I could really say. Check the numbers, make sure you've got somebody like Simon Hodgson there on board as for mortgages to make sure that the finance is right. And if it's a complicated accountancy setup, then somebody like Simon here on our call. I'm not going to try to pronounce that name, Simon, because I'm rubbish with the pronunciations. But yeah, essentially do your due diligence, because you're putting money down in advance on an investment that is an unknown entity. So research the numbers, and also, as much as you can, research the company that are offering the investment, the developer. Have they just started? Have they been in business for a while? Where do your background checks as you normally would for anywhere you're intending to put your money, but be especially careful if the returns look too good to be true. I've been offered various different investments, including parking spaces at airports and all these different things that come out of the woodwork, only to find the developers vanished once they've got enough money. So just do your due diligence is all I would really say.
Perfect. Simon, why don't you go first, and then Paul, I know you've got your hand up, so let's follow up.
Right, okay. This is a really interesting topic and area. So build to rent can mean a number of different things to a number of different people. So true build to rent can be done on massive scale, and as Bronwen says, there's a really huge one going on in Birmingham, and structured correctly. Yes, it can work and can work reasonably well. The kind of returns I think that were talked about on the message in, yeah, if it sounds too good, ... Now, within the sphere that we work in, and certainly the sphere I work in, I've met a number of property investors, and none of them particularly are fresh to the marketplace, who all have kind of gone into these kinds of things where they've been the smaller privately set up build to rent type scenarios, and a number of those have failed and their money's gone pop effectively. So what you've got to kind of remember is, if you've got a site that is looking to get funding via a build to rent scheme, if the site is that profitable, would the developer really be sharing that kind of profit with you? Because if they can borrow institutional money from the high street banks on the bigger developments at somewhere between 3 and 5%, and they then have second tier investors who then invest into them and lending the money on loan notes, it tends to be somewhere between 7 and 8%. That's enough for them to buy the site, develop the site, clear the site, and make a really great profit. If they're now starting to offer you double-digit returns in the future on your money, I would start to question potentially how and why they would want to structure their business and offer you that much money back. Can they not get institutional funding on that site? And if not, why not? Etc. etc. So due diligence is really, really key. And as I say, there are a number of people, number of clients I've got who have fallen foul of some of these smaller schemes. So be very, very careful, is what I would say.
Perfect. Paul.Hilliard, over to you.
Yeah, I'd just like to echo for Dinesh that what everyone said so far is very, very apt and appropriate, and please listen carefully. The other thing I'd say is that if they're expecting to give you a return on their project GDVs greater than 30%, then just be very suspicious, because unless they're very experienced and they can explain why so much margin is available, I think I'd double check what their projected rent figures are being achieved, and are their valuations being realistic. But the main thing I would say is that if they're offering you something that is too good to be true, then make sure you've got, if you are intent on borrowing to them or lending to them, then make sure you get the first charge on the project. Because if you don't get the first charge on the project, go for the first charge on the person's home. But it's got to be a mortgage. So, make sure you got your security.
Perfect. Thank you ever so much for that. One thing I've got a question on, and this is from Harry, again, on the Bronwen's Property Investing Foundation course. Harry asked the question, the National Residential Landlords Association, NRLA, is backing the introduction of a 10 million grant fund for tenants with COVID-related arrears. Teresa, what's your thoughts? I mean, Bronwen, Teresa looks bemused by that comment. So does that not exist at all?
Sorry, I was on mute. No, it does exist, but I suppose I'm just making a bit of a facial expression there, because it is just in Wales and in Scotland. So currently for tenants in those areas, if they've built up arrears from last March to the 30th of June this year, then they will be able to access, you know, a hardship grant. But yeah, my sort of expression is because there's nothing in the, you know, in England for, you know, for tenants here. So to reassure the audience, you know, the NRLA are pushing for that. You know, we're constantly pushing for that, for more help for the tenants, because a lot of focus is placed on landlords, and we, you know, a lot of landlords have suffered the brunt of the pandemic with tenants going into rent arrears, and we, you know, we are pushing, you know, for funding to be given to the tenants to, you know, to bring them out of that, so that landlords, you know, don't have to go down the route of mediation and seeking possession.
Wow, that's interesting. It really is interesting. But it's in just those two countries. Well, we'll hopefully see. I'm sure that there'll be pressure on the England front at some point. Moving on though from that, Mayor again on property investing course asked the question: if I'm moving from buy-to-let mortgages, so this is to you, Simon, from buy-to-let mortgages and starting service accommodation, what sort of mortgage rates might I be paying? And here's another, just to add value here to anyone listening. But if someone's got a normal buy-to-let property and they convert it to a holiday let, what things must they do?
Right, okay, well, absolutely, you need to inform your mortgage lender. There are a vastly limited source of lenders that will do or fund holiday lets, so you're likely going to have to, you know, as I say, move to a different lender. Rates are going to go up, so typically there are some discounted variable rates in the marketplace sitting at the moment at around 3.5 to 3.7, and if you've got a fixed rate, then you're looking, they start at 3.84 currently. That's whether you put it into a limited company or your personal name, either or, and those rates are available for properties that have C3 residential planning class. So they do not require you to have C1 planning. And if you get, or if you're looking at a property with C1 planning class, which is officially a hotel or a guest house, it's much, much, much more difficult to get borrowing on that.
Okay, and just to answer, I'll kind of talk about mortgages. What things do people need to have in place if they are going for holiday mortgages, because they are different? Are the things that people need to put in place to prove for their worthiness or whatever else?
Okay. Generally, then you're going to have a minimum of 12 months of buy-to-let experience before you can get a genuine holiday let mortgage. So you have to prove that you can run a normal buy-to-let property. It is massively more work than a normal buy-to-let. You know, a normal buy-to-let, you sign a tenancy agreement for 6 months, come to the end of that 6 months, and you might then extend it for another 6 months, and that might be all you get to see and talk and hear about. It's almost like a second job. So, which is why you have to have that level of experience and demonstrate to the lender. In terms of deposit-wise, 25% deposit is the minimum you're going to have to, or minimum you're going to have to put in. There are a few lenders there with 30% deposits, with which obviously the rate comes down a touch. Other than that, normal standard stuff for mortgage, you know, so bank statements, ID, copy of a credit file, etc. And it usually takes about the same time to get a mortgage in place. You don't need to have had the property running as a holiday let prior to that. So the lenders will generally either assess it on its normal rental, AST rental. So let's say you've got a flat that's worth 200,000 and it has a rent that comes in about £1,000 a month on a normal AST. They will assess it for affordability in that way, but allow you to carry out the holiday let business from it. Or they will ask the valuer to give forward projections for low, medium and high season, and then take an average of those over a period generally of occupancy levels of around 60%.
Perfect. Okay, Bronwen's raised her hand, so why don't you come in on this one?
Yeah, holiday lets again, very, very popular suddenly because of staycations, and I can advise you that really it's I know people who are just deciding to change their strategy overnight, and as Simon said, it's not something you should do without permission. with your mortgage company. But if anyone wants to see the pros and cons of holiday lets, I did a blog a couple of weeks ago that has proved very popular. So let me know, find me in social media, and I'll willingly send you a copy of that. Because I think it's a great strategy, but it's better to have really a bit of understanding, a bit of education first before you go headlong into that. That's my view.
I'm going to stick on with the questions that have been set on the property investments course from Bronwen. Andy on that particular course has asked, working with investor funds, when do I need to be wary of FCA rules and regulations? I know we had a chat before the webinar started, but Simon, you seem very enthusiastic about that particular subject. So why don't you share your thoughts and feelings?
Right, this is okay. So this, let me first of all say, not individual advice. Absolutely okay, and falling foul of the FCA is certainly not something you want to get involved in. It's a minefield, to be honest. So I think really what that person will need to do is privately message out to either myself or to Bronwen, so that we can understand how the money is being borrowed, from whom it's being borrowed, and who the entity who is going to be receiving the money is. And then we can then comment about the structure, because each of those elements will affect what and how you need to make it work and to do. Whether you fall into being a higher net worth individual, sophisticated investor, etc., etc., all are things that you need to take care of. And as I said before we started, I could talk probably for half an hour on the subject, and you really do not want me to start boring you for half an hour, for sure.
Okay. No,
I've worked a lot with investor funds, right from the first year of learning, 7 years ago. So I've always been very aware and very cautious about making sure that I don't stray into that grey area, as I call it. So, you know, I borrow funds from other people for deposit funds. I'll do joint ventures with people for particular deals, and you know, lots of pros and cons of working with other people's money. Massive responsibility, and you need to understand the rules. So yeah, happy to share and talk to people outside of this.
Perfect. Thank you, Simon. Thank you, Bronwen. Lily, I'm going to go over to YouTube live in a second because I can see some questions being posed there. So I'm going to do a stream of those. Pardon the pun. But Lily's asked a question about bank accounts and when you should use a bank account for your property portfolio. And stating here about, well, should you use it just for limited companies? And my view is, imagine that you have an inquiry from HMRC to ask about your rental income. Now, if your rental income is in the income is going into one bank account, which is just isolated for that property business, and the expenditure is also within that same bank account, then HMRC can only inquire about that one bank account. But Lily said, well, I've used it for my personal account as well. And I fear for that, because if HMRC make an inquiry and you've got it inside your personal bank account, which has got a number of activities going through it, then you've opened up Pandora's box to say to HMRC, hey, look at all of my income now, because they can have total access to that. And they will prod and poke into that bank account and say, give me that transaction, give me that transaction. Totally avoidable if you just use one bank account for your property business and then leave it at that. And I often say, well, isn't a bank account a good indicator of how well your business is doing? If your bank account is going up all the time in your property business, then that's a good demonstration in your profits. If your bank account's always going down every month and you're topping that up, that should be telling you something else about your property portfolio. You won't get that indication unless you have a dedicated bank account. So irrespective if you've got a limited company or indeed your properties are in your personal name, please, please, please do get a separate bank account, which will help you with the HMRC inquiries, as well as understand the cash flow from your business. I wanted to go on to the YouTube Live. Again, if you've got questions, feel free to type in your questions. I'm going to pause for a second, actually, because I want you to subscribe to the channel I want you to connect with myself, Bronwen, Simon, Teresa, Paul.Hilliard especially on things like LinkedIn, YouTube. You can connect with us there as well. I know that Tim.Bishop's got the YouTube channel. Again, make sure you go over to that channel. Bronwen's got a YouTube channel, so make sure you go over to there, see what videos we've got going on there. These guys are also going to do videos on my channel. They're going to do separate interviews over the next few weeks. I'm really excited about that. That's the first time that panel members have heard that, by the way. So they're probably now thinking, no, I haven't agreed to that at all. So again, lack of professionalism, which Teresa will pick up on me. So basically, I want you to do as much connection with these guys as possible. The more you know them, the more you will be able to build a relationship up, and you can pose questions and just get that familiarity. Don't forget to subscribe and like this video wherever you're watching it, whether that's YouTube, Facebook, LinkedIn, Twitter, it doesn't matter. Give it a like, give it a praise. But moving over to the questions, as I mentioned already, a couple of questions have come through. So Lorna Hughes heard us talk about these infrared heating systems. And Lorna said, these are market leaders in German. I have one in the office. They heat solids rather than the air, so reduce condensation mold and don't give dry heat. I'm not quite sure I really understand the science behind that, but I'd be really interested, Lorna, if you could share a link just to get us more educated on that. That'd be fantastic. Next Secret Liveth has asked a question. Hi guys, how long do you have to pay back the money we loan to our limited company? Is there a time limit? If you would loan money to your limited company, it can be indefinite. One big thing that I talked about on the last episode of the Project Expert Panel was the Director's Loan ISA account, whereby you could loan money from your Director's Loan ISA, charge it to your limited company. The limited company will get a tax relief on the interest that's paid to your ISA, and of course your ISA will receive the interest into the account tax-free. So if you haven't got a direct loan ISA, I will be doing a video on that in due course. I've just got to get through my own FCA checks to make sure that what we're doing is sensible and not going to put anyone in harm's way. And we're also going to do an article on that as well. A bunch of members on YouTube have said that they are NRLA members. Helen Tang, you said you're not, but please do make sure that you do subscribe to NRLA. You won't regret it. It's brilliant, absolutely brilliant. So Mike has asked a question. What are the panel member thoughts on being a long-distance landlord? We had this last time, actually. But being a long-distance landlord and how to best manage estate agents and tradespeople to avoid being taken for a ride. And I can't think of anyone better than Bronwen herself, who's in Botswana, of all places, managing a UK property portfolio. How on earth do you do it?
Great. Yes. Well, it's all about connections with experts, and that has been pretty much my strapline from day one. But I think when you're starting out and trying to find deals and building relationships with agents, etc., you do need to be on the ground, and you do need to be local, in my opinion, unless you've got really good sources or people that you know and trust in the places that you want to invest. And now this comes up a lot because people go, oh, well, it's much cheaper to buy in Hull than it is in Southampton. Well, yes, I know that, but I wanted to do it locally because I wanted to build relationships and find motivated sellers. And the way that I teach and I learnt was to do just that and get below market value properties if I can. So for me, that's my job. Now, there are lots of sources out there who are probably brilliant at that as well, but I didn't want to pay them to do it. I wanted to do it myself. So it's a personal thing. So I think the answer really is, if you're starting out and you're looking for deals, then I wouldn't be in Africa doing that personally, because even if the sources find something, I still want to go and check it, kick the tires and make sure the bricks are there. But in terms of managing properties, well, then, I use other people to manage all my properties, and I use Zoom, I use technology to manage the team of managers, and that works really well. And I did a podcast recently on just that subject, so I'll put that link in the box so that I don't ramble on for too long.
Fair enough, that's good. I've got a couple of questions that are coming in, again on, this is YouTube Live, interesting enough, and then I'll move back onto the property investing foundation questions. This is an interesting question for Simon here. Again, very similar to what we've heard before, is, hello, I found it impossible to get funding for mortgages because my income is all from property investing. I'm a high rate taxpayer of more than 20 years and good credit rating. Any ideas?
Yeah, speak to me. Pretty simple. Whilst it is a little more difficult, it shouldn't be completely impossible. Maybe we need to know a bit more background about that person, but assuming that they have a very straightforward background, no wrinkles in the credit profile, then it should not be impossible to find a mortgage, certainly. I guess, given the fact that they are a high rate taxpayer and they are already deriving all of their income from property, I should imagine they need a conversation with you, Simon, first, in terms of working out whether they buy in their own name or limited company. I would suspect it might well end up being limited company if they're already high rate taxpayer. Not advice, obviously. We've got an expert, Mr. Misiewicz, who could definitely provide that advice. But yeah, please do reach out to both Simons, please. We can definitely help, for sure.
Perfect. Just sticking on the YouTube Live ones, Glyn has asked a question, Wilkinson, this is, hi Simon, what do you and the panel members feel is realistic time period for conveyancing on a flat? Tim's not around, but mentioned that the offer was accepted today. To be honest, I've seen a variety of issues in regards to completing on deals for our clients. So I'm not just talking about personal. I've got a number of transactions going on as well. And typically we're seeing anything from 6-8 weeks all the way to 3 months. So it's some of the worst case scenarios, but what you have to think about is that your conveyancing solicitor may be very efficient. You might be using Bishop's Law. However, what is the other side? And Simon Hodgson, I'm going to bring you in because I know that you fully well know that there are some very cheap conveyancing solicitors being pushed on from mortgage companies.
Yeah, absolutely. So if you're offering a deal that has got free legals in it, that legal company have had to tender for that business against other legal companies, so the price has been kind of bartered down. What do you think that company's level of priority is? Do they service the client that they're only going to get paid a couple of £100 on, or do they serve the client that they were able to quote for normally without having to race to the bottom, and they might be charging that client £700 or £800, sometimes £1,000? So you will always find free legals is the slow lane, absolutely, without a shadow of a doubt. If you want to be in the fast lane, you're going to have to pay a little bit more. And the reason for that is that if you automate all your process in your business, literally you just respond to emails and fire questions back to other solicitors. Don't pick up the phone, don't answer the phone, and that's the most efficient way of dealing with your time, but it's the slowest way. If you've got a bridge that's going to complete, and I've just had a bridge complete in 7 days. We completed a day before the stamp duty holiday ended. Yeah, so that's from application, offer, conveyancing, completion, all done in the space of 7 days. I had to pick the right solicitors to make sure that was actually going to happen. Can be done. You just got to pay for it, because you can imagine you've got to pull that job to the top of the queue. So therefore, you have to be on the phone, you have to be monitoring your emails, and you have to stop everything else you're doing in order to prioritise that case. You can't do that for £200. It's just not possible. Not if you want a business. You can make some pocket change. Yeah.
No, it's interesting. No, very interesting. I'm going to go on to some of the questions that we had again on Property Investing Foundation. And I want to bring in Wayne, because we've not had Wayne talk for a while. So Wayne, I want to talk about capital allowances. Hopefully you can explain what capital allowances are from your industry, if you can, if there is a possibility. But from a tax angle, people talk about capital allowances, and we've seen a couple of organisations, let's call them, whereby they said you can get capital allowances on HMOs. And pre-2012, 2013, this is a going rage. It was kind of, yes, get a HMO, you can get a nice capital allowances claim. But from 2013, interestingly enough, HMRC fundamentally changed the principles around capital allowances. And it used to be that on shared areas of any accommodation, you can claim capital allowances. And basically that means you can get a huge tax write-off. But in 2012, HMRC fundamentally changed it to say, well, anything to do with residential, which HMOs are, any shared areas, such as bathrooms, kitchens, cannot be claimed at all. And in fact, the only area that you can claim is the stairway. That was pretty much it. And there's been several, we work with a company called Six Forward. So anyone's looking for a good capital allowance expert in the world of tax, we refer quite a lot of work to them because they know what they talk about from the tax. And fundamentally, they established 3 cases whereby landlords being taken to court by HMRC, and HMRC won every single time. Because of the said accountants that said you can claim capital allowances on HMOs. So to be very careful when it comes to capital allowances and bogus claims, marketing claims from accountants that are using out-of-date legislation to say, hey, here's a legislation piece of reference. This is all the things you can do, when it's fundamentally out of date by about 6 years. More, obviously, now. But Wayne, from your perspective, you can claim capital allowances on commercial buildings and service accommodation, that still exists. But when do you get involved in capital allowances or anything like that from a surveying perspective?
Thanks, Simon. The key thing is, you mentioned it there, this is a complicated area that changes rapidly in theory annually every time there's a budget. So from a surveyor's perspective, we don't generally get involved in that kind of discussion about capital allowances for that reason. So if anybody wanted me to advise them on it, I would put them to you, to be frank, as an accountant. And I think anybody who's dealing with that, I was chatting to a chap the other day who was talking about how he was offsetting 2 different companies and capital allowances against VAT, etc. And it was really complicated, the things he was trying to do without any specialist advice. And I've referred him to you because it's an area that if you get it wrong, you could go to prison. You could lose a lot. So don't play with it. And if a surveyor gives you general advice, then I would suggest you back that up with some formal advice from somebody like you, Simon. So I'm going to back out of that answer and hope that's sufficient to give a surveyor's answer.
No, that's good for me. That's good for me. I think it's just people should be warned about it at the minute. Like I say, we've had 3 clients approached by this one company. I'm not clearly going to be saying who they are because I just don't think that's professional. But if you are getting people approaching you about HMO capital allowances, please stay away from them. Bronwen, what's your thoughts?
Well, I've got HMOs and I've got guest houses. So it's the guest houses, the commercial property that you can claim back. And one of them is a 26-bedroom short-term accommodation property, pretty big. The amount of capital allowances, of course, for all the shared areas, the heating system, the CCTV, it's massive, massive. So I think we were talking about £200,000 of capital allowances that we could then spread out over a number of years, because you can go back and claim them. Now, somebody in that property may claim them in the past. So what you have to be careful of is that, you can't you can only claim them once. So for us, what we did was, because the previous owner was a charity, they wouldn't have been able to claim. So it was pretty straightforward for us. We were, you can deal with an expert, of course, and I have an expert if anyone's interested, and he was able to check and say, yes, you can claim them. And it costs us a bit of money, of course, but hey, all that offset was extremely valuable, especially in our first few years.
That's valuable. I think in terms of anyone listening out, capital allowances is still a good thing to do. Just make sure it's on the right type of properties. That's all I'm asking you to do, guys. That's all. Moving on. Ethan has asked a question, can I offset property education costs? Yes, you can. There is a trick to this, actually. It basically says, if you are buying education materials for the first time usage, then that cost will be capital. So what we've always said to people is, well, if you've got property you already experienced, so if you then buy furtherance of property education, you've already got a good education, because you wouldn't have had properties without education. You have to have an education to begin with, whether that's self-taught or anything else. Now, when it comes to, if you're beginning in property and you go on a course without any pre-education stuff, then all of that cost will be capital. So the best thing to do is buy Bronwen's book. That would then be capital in nature. And we'll talk about that book later on. There you go. She's just showing that. But I've got a better image, because yeah, there you go. You can see like building your dream life. And Bronwen can talk about her dream life, of course, in her book. She probably talks about that. But the thing I would say about the second education, so if you bought into or invested your money into Bronwen's second course, which is the online course, then all of that cost would be offset against your rental income, irrespective if you use a limited company or your own personal thing. So it's a great question. It's a commonly frequently asked question, but I do take umbrage when I hear accountants saying, well, education itself cannot be expensed. Well, if you are investing in property like I did, I had 7 properties before I did any investing education, to be fair. But I had a good claim to say, well, I was already educated. I'm just furthering my education, not making it new for the first time. So there is a lack of understanding on that regards. I'm going to move over to another question, if I may, and this is from Sally. It says, if I buy a property with tenants in situ, what do I need to make sure I'm covered legally? Pros and cons of buying with tenants. Unfortunately, Tim's not with us. The Gigolo will be back in 2 months' time, but he's doing another session with someone else at the minute. I'm sure we'll hear all about that in the next episode, when we'll get him to talk about it and apologise to you as avid listeners that love his pilot sounding microphone that he has on a frequent basis. So unfortunately, Simon, I won't be able to answer that question, but Simon Hodgson, are you able to, Paul's got his hands up, but Simon first, and then Paul, if that's all right, to answer that question.
I would have thought the most obvious thing would be, first of all, check that they've got newly signed tenancy agreements, so that they're kind of up to date, which I'm sure Teresa's going to come and kind of tell us all about that. Yeah, that's the main thing. If it's known as a lifetime tenant, then you've got pretty much next to no chance of getting that sorted, and steer well clear. Getting funding for that is nigh on impossible. At rates that make sense, I should say.
Paul, go for it.
Yeah, so I totally agree with Simon. The other thing I'd say is make sure you get an up-to-date rent statement. I've recently bought one via auction, and nothing was mentioned until the very last minute, 2 days before completion, when they said, oh, we've got to send you a rent statement. I said, yeah, I'm expecting that. And then they go, and don't forget you've got the arrears to pay. And I went, interesting. And that is a valid clause within the terms of the auction standard conditions, G11, I think it was. But needless to say, I stuck to my guns and refused to pay and said, you didn't give me fair notice. But I was lucky that the auction company supported my claim on that. But so if you are buying, make sure you get an arrears statement prior to exchange, as arrears can be added to your purchase price and may not be recovered. You know, if they've got arrears, what chance have you got of recovering them? Get a full reference checks for all the tenants, and if any tenants fail, then insist on vacant possession. So vacant possession is far safer, but is likely to impact your cash flow, and that's the reason why I went for the particular one in the auction. But over to you, Teresa.
Yeah, some really good points there, Paul. and Simon. I would just say that, for landlords now, if you haven't got your, your documentation set up properly at the start of tenancy, then it can be very, very difficult to seek possession through the courts. Because you just got to tick so many boxes and have so many things in place beforehand. So as well as checking sort of rental statements, I'd probably be on the phone to the advice line at the NRLA and be sitting down and saying, this is exactly what they've made available to me. This is a type of agreement that they're on. This is the documentation that they were provided, at the beginning. So, I mean, it is possible to do it, but it's just, doing your due diligence, as always. I'm sure the panel will agree. That's always the number one tip. I mean, it can be a success because, you could have a good tenants. So you've got no voids, your cash flow is there and instant. But if it's done wrong, then, you could be hit quite hard. But also as well, if you take on a tenancy like that, you do need to fill in certain forms to do like a change of landlord sort of agreement. So, but yes, that's what I have to say on that one.
I'm going to stay with you, Teresa, if it's all possible. There's a question that I can see not connected by this by any way, but it was regards to well, I just lost it now. Sorry. But do bear with me a second, caller. Your call is important. Here we are. Tony Funk has asked a question on YouTube Live. Anyone listening to YouTube Live, make sure you do give this video a good thumbs up if you find it interesting and subscribe to this channel. Tony's asked a question. Hello, I heard from other landlords who said that they don't do ASTs for their HMOs anymore, as it is getting difficult to get rid of them, even if they are problematic or not paying rent. I'm going to go over to Teresa to begin with, because that's frightening. And then Paul.Hilliard to see if you do anything in regards to flexibility of ASTs.
Right. So from the NRLA stance, we're just using, contracts. We're not using leases. So I haven't got any sort of speciality in that. But I would say that, the majority of landlords are using ASTs. And you'll find that, if you're taking on tenants with benefits, you'll get asked by the DWP, can I have a copy of the AST. If your insurers will say, have you got ASTs? Your mortgage companies will probably say, have you got ASTs in place? So I think I'm saying the right thing because Simon's nodding. So there's obviously, landlords will be trying all sorts of things out there, but it doesn't necessarily mean it's going to be a right fit for you. So if you were going to go down the lease route, then, make sure you do get the advice regarding that.
Simon, any thoughts on this?
Yeah. Leases in place will then restrict the number of lenders that are going to lend to you, for sure. Absolutely. So there are lenders that will work with leases, but generally they're leases from, say, housing associations or charities to you on a guaranteed payment basis. For an individual basis, you're going to massively restrict lending, for sure.
Interesting.
Yeah.
Okay.
Simon, I think we're probably referring to license agreements, which you tend to find within social housing that they use, and then the housing associations can remove the tenant within 7 days if they fail to do what they agreed to do. But yeah, for HMOs generally, room agreement ASCs that the NRLA will supply you with a tenancy agreement. So go for it. Don't do. It's so risky. It's not worth it doing lease agreements.
Teresa, your hand is up again. I wasn't too sure if that.
Yeah. No, because part of that question was, or the statement was, that it's difficult to get tenants out these days, and that that is a fair point. It is difficult. And that's why you just need to be really careful when you get a tenant. So you do the reference checks, and even going visiting them and making sure that you meet them, and you don't get anybody in a hurry. For example, you don't just think, oh right, yeah, I've got a tenant, let's just get them in. You really do have to make sure that they're the right fit for the property, and making sure that you have all the paperwork set up properly. Because if you if for example, you don't give them a gas safety certificate, that's it. You're doomed, basically. That's what I just wanted to add there.
No, perfect. I'm just looking at the other questions from the Property Investing Foundation course, and there was a question in regards to, and this is a really interesting question. What has changed in the UK property market now that companies like Lloyds Bank and John Lewis have started out as landlords? Now, as far as I'm concerned, they're only doing commercial properties. I wasn't aware that John Lewis was doing residential, but I know that in Oxford Street they're converting their store, but they're not actually proactively investing. I think they're just converting stores, my belief is. But Teresa, what's your thoughts on Paul and Bronwen?
Yeah, I mean, I thought they were basically, large investors in the private rental sector. So probably mopping up all those properties where landlords are now just throwing the towel in. So yeah, I do believe it's happening.
Wow. Bronwen?
Yes, it's definitely happening. And I think I think those two announcements have literally been in the last week. I used to work for Lloyds Bank 21 years, and to see them now stepping into this area, what they're looking for is shareholder returns. And they can see that the property market is not only got a lot of demands, but actually they can be getting a good return for shareholder funds. So it's pretty new, I think, for banks. But John Lewis is literally the other day announced that. Now they obviously own commercial property, and they can then use their asset to create a different sort of income, and diversification on the retail high street is what it's all about. So I think these are just, these are two very large organizations. Just, there'll be plenty more, I think, that will venture into this space, because we all know that there's such a high demand for rental at the moment. So
Paul?
Yeah, I certainly in respect to John Lewis, what they're doing is, instead of them having to sell their commercial premises at a potential loss, they're taking advantage of converting their commercial properties into rental properties, i.e. using permitted development rights. Yeah, that's what professional investors are looking to do at the moment themselves. The other side of the coin is that money in the bank is getting such a pitiful return, less than 1%. So it makes sense for the banks and John Lewis themselves to, let's invest in the property market. I'd have thought some of them will be on the commercial let side, because they're looking at 5% return, which is good for them. Yeah, I'd say, look at your cash returns. If you've got money in the bank, why have we got it there? There's a certain guy called Grant Cardone who said cash is rubbish. So, and I've seen him rip up £50 notes, but he can afford to do that.
Not very sensible. Anyone who's got £50 notes and wants to rip it up, I'll send you my postal address. Just feel free to send it there. If you don't want it, that's fine with me. Simon Hodgson and then Wayne.
I did put my hand up and then I kind of put it back down. But yeah, it's a really interesting development, isn't it? If you imagine an institution like Lloyds borrows on the international interbanking system, very low rates, and then lends it out. Typically, your buy-to-let, it might lend it out 2% in personal names. Limited company, it might lend it out 4%. Quite often, residential properties only yielding at 4 or 5%, or let's say they're stressing at 125%. So there's a bit of extra, it's not massively extra money they make on it. So I'm very interested in this development, how it might go, and whether more institutional money might well come into the market, because it would then give the government powers to start making smaller landlords or legislate against the smaller landlords. So watching this one with very, very interested eyes, for sure.
Yeah. Wayne, what's your thoughts?
My thoughts are, well, firstly, I think, as you say, it's a breaking news. It's quite a new development, if you like. Lloyds and John Lewis, and there's going to be Marks and Spencers and the others you would imagine with the big old historic property portfolios in town centres. Those bigger units are not shifting nowadays unless they're developed. They're being redeveloped. We've got a couple in Bournemouth that are being redeveloped at the moment, and they're turning them into exclusive city centre flats. So why wouldn't you do that as the building owner, if you can, rather than sell it to a developer and let them make the profit? Why don't you act as the developer? they've got the expertise in-house, or they can bring it in. And then I doubt very much whether there'll be active property landlords that we would define as a property landlord, i.e. I've been an operational and a non-operational property landlord for national car parks, as an example, and others. It's complicated managing residential lets. I think they'll be developing it, turning it into the units that they want. And then, and here's the key point for new property investors, where something's new, there's an opportunity. This is new. I believe there's an opportunity for people to step into that breach, speak to the likes of Lloyd's, M&S, John Lewis, etc., and say, you want to develop it, fine, we can help you with that, but we can manage the residential letting part of it for you down the line, because they're not going to want to do that. I'd be very surprised if they want to take on that liability and potential damage to the brand.
Fair enough. That's good. That's good. I'm going to ask you another question, but just in case anyone's wondering, there's a blue bottle. You can't see it because of my background, which is a good thing. This blue bottle, whenever you do see it like that, there you go. You're probably thinking, well, is that London Blue Gin that he's drinking? And you're right, it is. It's amazing that I'm actually still sitting on this stool. I've had 3/4 of it, and it's not, by the way, it isn't. Teresa, I'm very professional. I'm very professional, and on the beat they would never allow it anyway. But it is just water. It's just a coloured bottle in this hotel, so it's all inclusive. So you know,
I think you have been drinking, Simon. You just
I'm hiding it away.
Going on a bit now.
Thanks. I'll move on. So Wayne, over to you. I've got a question, regards 2 questions for you. So I'm going to ask one and then the second one. Carrie asked about a property buying with a property has spray foam insulation. Could this be a problem? I'm going to go to you, Wayne, and then Simon, actually. I don't understand the question, but they've got spray foam insulation in the property. Surely you could just take it out, unless, Wayne, you're going to tell me it's scientifically needed.
No. What's happening, it's not just a simple matter of taking it out, and that's part of the problem with it. So at the moment, because of the government grants, there seems to be quite a few people going around selling innovative products. One of them is what I term as spray foam insulation. And recently, I've had a couple of clients who have been asked me to do surveys of property. I've gone in, spotted the insulation, and from a surveyor's perspective, it's difficult to tell what type it is, what it's made of, whether it's fire resistant, etc. So some of the problems with it are, firstly, and Simon Hodgson will probably comment on this as well further, some lenders, is my understanding, don't want to lend on properties that have that sort of material in. It's difficult to remove. Essentially, Simon, what they do is they spray it in and it sticks. It's like if you've ever seen the expanding foam that you put around pipes to fill pipes or gaps, it's the same kind of thing, really. In essence, it's a foam that expands and sticks to wherever you put it. So you line the underside of the roof and other areas, it's very difficult to get rid of it. And like anything, when you put a lining on a roof, let's say, if you get a leak from the tiles, water comes in, potentially gets trapped rather than run out or ventilate away, then you've got timber decay and you've got other problems. If you need to do repairs to the roof or replace the roof, you've got to get rid of the material first, which can make it more costly and difficult. So, but the key thing I would say to Carrie is, if you've got it, then put the brakes on for a while, find out as much as you can, who installed it, are there guarantees, speak to your mortgage broker to make sure that your mortgage lender isn't going to have a problem with lending on that kind of property, and take note that going forward down the line, as it ages, as the building ages, there's a higher risk of defects, or can be at least. Over to Simon.
I probably echo most of the things you said, Wayne, really. Find out who's installing it, what exact system it is. I'm surprised how infrequently it actually comes up on mortgage surveys, for the very reason that you said, Wayne. Most surveyors, no matter how competent, it's not exactly easy to spot, is it? If I'm not mistaken, when you're on site. Yeah, reach out and tell us what type it is, and then maybe we can give you more specific information.
I'm on mute. So Wayne, staying with you, non-standard bricks such as post-war prefab council constructions What's the issues and why can't I get a mortgage on them? So I'm going to go with you first, Wayne, but then straight back over to Simon yet again.
We're double teaming here, Simon. I'm not sure if that's the right phrase actually, but we'll go with it. So essentially, I explain it like this to my clients to keep it simple, because a lot of people don't necessarily understand how mortgages work. And maybe Simon will correct me if I'm wrong, but I explain it like this. A lender has a pot of money that they're able to lend in a particular period. What they want to do is reduce the risk of having problems should they have to recover that property, i.e. their money, down the line. So therefore, different lenders have different tolerances to different things, and hence why you can go to one lender and find out you won't get money, you go to a different one and you'll get it, or it may be at a higher rate because they're offsetting the risk by getting a better return on the money. So non-standard properties, there's lots of potential defects with them that have been established over the years. And one of them, for instance, is that the steel that holds the plates, the panels in place, can corrode. Very difficult to see it because it's behind the panels and it's built in. So therefore, lenders know that this is a historic problem, and some lenders will say we're not prepared to lend on that unless it's been repaired, and unless it's been repaired in a particular way. Now, I think it's fair to say Nationwide have always been the market leaders in what they want in terms of reassurance that their money is going to be recoverable down the line. But there's really the main reasons why lenders don't like it is because it's a higher risk for them. When they've got a finite pot of money, they can spend that money on a traditional brick-built property in the good times that we're in now, where people are fighting for their money. Why lend it on a risky investment when they can lend it on a less risky one? But anybody who's thinking of buying a non-traditional property, and there's many, many different types around the country, then you need to have a building survey on that, really. The level 2 home buyer report isn't really designed for those kind of properties, apart from the wimpy no fines or that kind of property that's a bit more straightforward. I'll pass over to Simon. Hopefully he's not going to overcorrect what I've just said. But
no, indeed. Yeah. Okay. So yeah, the more common type that you mentioned there, Wayne, wimpy no fines, it's not every lender's cup of tea, but there are enough lenders out there to go and get funding on it. But the more esoteric concrete construction methods, yeah, can be a real pain to fund, and for that very reason, if you've got effectively steel rods where the concrete panel is effectively slid onto, you've got no access to that steel rod, and if you need to carry out any kind of repair to it, it is pretty difficult and costly to put right. So effectively, the value of the property will dip at that point if it's found that there's an issue with the construction. So therefore, the lender can't lend the money out in a safe or in a way that their funding line